Hello and welcome to another exciting episode of Finance Footnotes. My name is Brent Stransky and I'm here with my friend and co-host Zach Miner. Today is January 23rd, 2024, and we're here to discuss what's coming and going in the marketplace today. Markets are all-time highs. It's been an exciting time. Strong last year. The market's been whipsawing around so far in January. I'm going to talk a little bit about where we are. Okay. It's been a long time since we hit new highs. What can we expect going forward? I'm going to talk a little bit about consumer sentiment and how it plays into markets in general and the economy. And then finally, I want to talk a little bit about how hard it is to make predictions, especially about the future. Zach, what do you have for us today?
Like Jeopardy, all of my answers are formed in the phrase of a question. So we'll have some interesting things to look at.
I like it. Did you have a chance to look at my first slide? If not, don't do it now because I have some questions for you. Let's just roll things off here with some exciting
I didn't.
exciting notes.
I did not.
I like it. I like it. Okay, cool. So Barron's is a magazine. It's run by the same company that the Dow Jones that owns the Wall Street Journal. It's much less syndicated, but I love it. It's got a lot of ideas in there, great and bad and otherwise. But every year they do an annual forecast, and this is just telling you folks at home how tough it is to make predictions, and how foolish it is to try. Okay, so every year they come up with a survey. Anyone's open to do it. Last year, 3,400 entries into the survey. It's 18 questions. Some of them are true or false. Some of them are multiple choice. Okay, but there's 18 questions. So without looking, Zach, and so some of them, will inflation be above 3% next year? Will be above 4%, right? So pretty simple, standard questions. Will the S&P have this return? Will bond markets do this? Will the Fed do that? So 18 questions. 3,400 daring souls, made the wager to try out and see if they could succeed. What was the average number of correct answers across the board of 18?
So 18 questions, 3,400 people. Was there a market price targets, or was it more just economics?
It was not price target. It was a mix. Will the market be up, 20% next year? Will it be down 20%? So,
I'd say
quite a few.
Definitely, I would definitely say less than 50%, maybe less than 30%.
It's great. No, smart. So only 4.1 is the average correct answers of 18. Because it's tough.
20%? Okay, yeah. One out of five.
It's hard to get these things right. Less than 25%. The highest question the question that received the highest number of answers correct, only half the people got that one right, and is whether or not the Fed is going to lower interest rates in 2023, which is low-hanging fruit. The high score was 13. That was the big winner. Still got 5 wrong. And then I thought this is funny. The Barron's editor, who I read a lot, smart guy, only got 2 right. He's significantly worse than the average, which is also terrible. So only reason I say this to you is we have to, remain humble as we're filming these podcasts. It's really hard to talk about the future. Even smart people, you've got to be pretty, confident to, wager on the 18 questions that Barron's puts out every year, because it's a humbling experience. So it just reminds us that it's okay to be wrong and to try to be as, agnostic as possible.
It's funny.
Exciting times here. So I wanted to introduce that, and I want to move right into where we are. We talked about this in the last couple of podcasts, but I think it's intriguing. The stock market, and by that we usually mean the S&P 500, which is the largest 500 publicly traded stocks by market weight in the country. It went over 2 years, over 500 trading days without putting in a new high, and that's not necessarily common. In fact, it was last Friday it put in a new high, so that was the 18th, I believe. So really, or the 19th, really intriguing that it went more than 2 years. And so there was some great data that came out from 2 sources that I'm going to cite here. But the first chart I have here is that it has been over that amount of time. The peak to trough decline was over 25%. It took 14 months for it to recover, and then 24 months for this current cycle to hit a new high. Okay. So what does that mean? What does it mean when there's been 2 years of distance between highs? And typically that's actually a really good thing. So I think this is kind of, maybe coming into some of the technical support here in the market as we go forward. But the S&P has averaged 11.7% after it's gone more than 12 months without a new high. So it's been positive 12 of the last 13 times, going back to the 1950s, with an average total return of almost 12%. It's great. So I'm excited by that. Just to kind of bolster that particular point, this is a chart here on the next slide I have from our friends at Carson Research. And it just has the last 10 periods that had at least 12 months um, between highs in the market. Okay. And there only have been 10 times. And you can see here that they're saying that it's been higher 90% of the time. So pretty good supporting data there that things could continue to grind higher through the rest of the year. What do you think, Zach?
Yeah, it's interesting on kind of the first chart that really half of those fairly long bear markets were absent a recession. So that the far right column on that slide 3 where it says kind of recession, yes or no, it's kind of a coin flip whether or not there was a recession. And if you do kind of go across, you can see that if there was a recession, the price decline was generally much worse. You got 40s and 50s and
Hmm.
high 30s in there. Whereas if there wasn't a recession, you're looking in the teens and 20s% decline wise, during that period. But it does kind of seem like there's really the actual length of time is kind of mixed. Sometimes there's single digits, sometimes there's double. So, well, I think that's a pretty interesting
I
thing.
thought that was interesting too, kind of looking at that chart. With the Where Are We chart that came out from LPL Daily Market Research yesterday.
Mhm.
Yeah, so for all of these bear markets, the 13 that there are observances for, the average duration of recovery is 19 months,
Yep.
and the between highs is 30 months on in total. But with no recession, it's 17 months. So we just came through a 24-month cycle, maybe a little longer than average for a no recession cycle, but um, interesting nonetheless. So I think it could be supportive of, strong momentum coming into the next 12 months. I'm
Yeah.
excited to see what happens.
And I'm gonna do a live bump up of my first chart here, just
I
because
see that. Okay. What do
it
we
really
got?
speaks right to that. And I think that what we've really seen over the last 10 years, at least through my career and working with advisors, that we've kind of always been waiting for that other shoe to drop. We've been waiting for that next big one, so to speak. And if you look in here, that 2-year period, that 24-month period without new highs, was the seventh longest time we've ever went, going back to 1928 for the S&P 500.
My God, it's so hard to believe.
Right. I mean, it didn't necessarily seem like it was, of that magnitude. And I think because we have that recency bias where we have those back to back 2000 to 2007, 2007 to 2013, really 13 years where the market kind of just grinded sideways, that's really stuck in our memories. And we have those really long periods, but that's number 3 and 4. And since they were pretty much back to back, you can kind of combine them together. And that's essentially number 2 outside the Great Depression in the 1930s and 40s, which was 25 years, which is crazy. But so you kind of look through that. And for a lot of investors that lived through that and worked through that, you have that in the back of your mind and you're just kind of always waiting, like, oh man, when is the next big one, right? When is this next 50% multi-year decline going to happen? And the reality is it's very rare. It really doesn't happen outside of those 3 periods when you look at the Great Depression, yeah, the inflation crisis of the 70s, and then kind of the twin crises of the early 2000s, the tech bubble, and then the financial crisis. Outside of that, it really doesn't happen. And just this last 24-month period was the seventh longest. So I just think that
It's
really kind of speaks to that recency bias where we have that sense of impending doom. But that's really the anomaly. That's not something that is typical.
I think it's a great chart, and it does lead to my next point. I think the recency bias is a powerful indicator through my investing life, your investing life, everyone paying attention to this podcast right now. You know, the last two major cycles were substantial. Two or three sigma moves, right?
Yeah.
Much worse than normal. And I think it's affected people's psyche, right? And so this leads into my next slide, and it's the last point that I want to make today is that hey, people are starting to feel a little bit more optimistic. So I have a slide here. It's from the University of Michigan. They're famous for their consumer sentiment poll. It grew by 29% from their November reading to mid-January, which was released last week. It's the fastest increase in over 30 years. But it's still 20% lower than the pre-COVID figure. Reasons for the improvement: decreasing inflation, decreasing gas prices, and then mortgage rates are falling, which also helps. So, if you look here at this chart, you're seeing that, up until the, COVID, the reading was about 100. Okay. And that's just an arbitrary figure chosen when the index
Index
first
started.
began.
Yeah.
Thank you. And you can see that, my God, it's really crashed down to 50 during, after it was even like, it wasn't even COVID. I mean, COVID had crashed down into the 70s, but it crashed
Right.
down into the 50s, like with a
2022, yeah.
50 handle. Yeah, because of the inflation, people were pessimistic. I think at least multi-year pessimism going across the board, and we're rebounding from that. And I think we could see that play out in several ways in the economy, possibly through spending, supportive of the economy. But I also think that we're coming into an election. People are I don't know, maybe being a little less pessimistic than they were before. So hopefully we'll start seeing that play out on several aspects, which I think will be beneficial.
Yeah, it's the old James Carville. It's the economy, stupid. So I think that that does definitely speak to a potential, for how the election may play out. If consumers are generally feeling good about the economy, that tends to bode well for the incumbent. And there's still, 8, 9 months till we get to that
There's
point.
still 3 or 4
A lot of time.
lifetimes until election, it seems.
Yeah, it's three. Yeah, it certainly is three or four political lifetimes until we get there. But
Yeah.
that's an interesting chart. So we've been talking a lot about the Magnificent Seven. How these seven stocks have really driven these seven large tech names have really driven the performance of the market. And I thought it was really interesting is that they're not particularly remarkable companies when it comes to growth is concerned, and they are very remarkable in their own idiosyncratic ways. I mean, Nvidia with their kind of monopolization on the chip creation for the AI. You have the Microsoft and Google, essential, yeah, some of the largest companies on the planet. But when it comes to just pure growth, um, if is this chart from Richard Bernstein did a screen for earnings per share growth, forward earnings EPS growth of greater than 25%. Only three of the Mag 7 even show up in there, and none of them are really in the top quartile of highest growing companies. So I thought it was interesting that there's quite a lot of growth out there, in the market. And if we go back to our prediction show and what we kind of talked about the potential for this year is that there's, I think, a decent amount of potential for the rest of the market to kind of catch up to those guys that led the way as the generals. But there's still a lot of growth out in the market. And those companies in particular were not necessarily the fastest growers. And really, only three of them are even on this list of 25% EPS growth at all.
It's so funny how much we're talking about the Magnificent Seven. It used to be the Magnificent or the Fantastic Five or something a couple of years ago, and it was five of the same names. Now it's the seven. They kind of expanded to
Right.
include like just to grasp the best performing, so the index looks more attractive on the news feed, right?
Yeah.
But let me ask you this question, Zach. Would you say, in your experience, kind of peeling through the news feed over the last several months, um, has there been kind of like a consensus that that the Magnificent Seven are overweighted at the moment?
Well, definitely overweighted relative to history. So if you look at their contribution and their composition of the S&P 500, they're certainly playing a larger role in how that index moves relative to the history of that index. Um,
I think that's absolutely the case, and I think it segues with at least some of the prognosticators that I'm reading are definitely suggesting underweighting that Magnificent Seven going forward. Hey, focus on the value of the 493 at the expense of overweighting. So maybe like an equal weight, for example. But it's been so, at least in my experience, and I don't want to I do not want to make a prediction here based on the first slide I showed you here today that's a fool's errand. But it seems to me everyone at the moment seems to be saying underweight the Magnificent Seven. My humble experience and what I'm reading across the message boards and whatnot. And it could be, if we're contrarian in nature, that they outperform. They perform better than expected. So
right.
I just want to keep an eye on that. We'll have to see what happens, of course, but it's interesting.
Yeah, it is interesting, and it was the case a year ago, right? So they were still overweight, and if you look just a year ago, and obviously that didn't work out for you if you chose to underweight them, and even just looking the first three trading weeks of the year, I mean, Nvidia is up 25% in 23 days. Um, so if you had come into the year with that as on your mind, well, that wasn't right yet. It'll be right eventually, but kind of just goes back to that very first question about predictions and things of that nature. And look, momentum and inertia is a hard anomaly to go against. And so they certainly have the momentum for sure. But I do think that there's an opportunity for the rest of the market, especially a lot of the names on that list here, to participate alongside them, rather than them having to come down. So I think the rest of the market could, potentially catch up. Next I wanted to go into a little bit about inflation, and this is just because we've been talking about the fact that inflation is kind of going away. The Federal Reserve has really pointed to the fact that we're almost here to our landing zone where they're gonna probably cut rates this year. But there's geopolitical reasons why that could potentially reaccelerate, especially on the goods side. And so I put two charts in here for the Panama Canal and the Suez Canal, where traffic has declined by 50% going through both of those different canals for two completely different reasons. The Suez Canal is because of the geopolitical issues with Yemen and their attacks on ships in the Red Sea. The Panama Canal was more weather related. There was some drought issues in Panama, some political issues there. So these ships are having to take much longer routes, especially the Suez Canal ships, who are having to essentially drive all the way around the Horn of Africa in order to get to Europe, as opposed to going through that canal, extending trip times by multiple weeks. And that's a lot more fuel. That's a lot more wages, time at sea. Kind of a re-snarling of some of these supply chain issues that took a while to work themselves out after COVID. And this could definitely filter back into the goods prices again, which the goods inflation had essentially evaporated. We were really, the last 12 months or so, was really just concerned about more services inflation, and especially kind of the housing component of inflation. But the goods inflation had really started to essentially dissipate. So this is the one thing that we want to keep an eye on that could put a bit of a hamstring on the Fed if goods inflation reaccelerates, and we see that number doesn't quite come down as quick as they wanted to or they expected to, for reasons that are totally outside of their control. I mean, these are things that they're not economic in nature necessarily, geopolitical and the weather. But it could feed into higher for longer rates, maybe not as many cuts, right? And if the market got ahead of itself with regards to pricing in these rate cuts. So I think that's just one thing to keep an eye on, how long this lasts, what impact it ultimately has. But a not insignificant percentage of the world's goods travels by these canals.
There are many variables in the inflation data. And we'll have to see how it plays out. So in other words, this is not necessarily unusual to have these type of anomalies float up, and we'll have to see how it plays out. I want to give you credit, my friend, for using the expression re-snarling. I think that's fabulous. I think we should all have it in the lexicon more often. I like it. I'm gonna use it for sure.
There you go. Yeah, absolutely. And then I wanted to zoom out a little bit in an election year, and everyone's talking about how our government should interact in the marketplace and how our government should impact different industries. And so this next one just goes back until the mid 90s and looking at different
This
classes
is a
of
great
goods
chart.
and whether or not they've gotten more expensive or less expensive. And you can kind of guess, if by ranking the things on the right-hand side there, that the more that the government is involved in it, the more expensive it has become. And that's not to say necessarily regulatory, because there's not much regulation when it comes to, college tuition or college textbooks. There certainly is in hospital services and healthcare. So it's not necessarily a regulatory burden, but it's an externality of the government's involvement at all in these industries, whether it's by funding, whether it's by regulatory, or whether it's just by their function of being
This is
involved in
not
it.
real. This is not real prices.
No.
This is not okay. So very interesting. Yeah, just looking at the college and tuition here. Obviously that's high and front and center for a lot of folks. 180% over that period of time. But the point that sticks out to me, Zach, is that if you look here towards the median, the 50% over that 20 years, you see that food and housing and beverages had a lower inflation rate than the annual wage in the country, which of course is a lot
Yeah.
of skewness in that particular data set. But heck, that's the major thing we want to pull out. People are earning more money than it costs to live, unless you have a bunch of kids going to college.
Yeah, yeah, for sure. And so I think that just, as we're trying to think through how we want our government to work and who we want to lead it, I do think that generally government involvement produces inefficiencies, uh, regardless of how they're being involved. And especially when it comes to college, and you point that out, and college funding is certainly a topic of conversation with a lot of our clients and with a lot of advisors. And there's no incentive whatsoever for colleges to reduce prices, uh, because the federal government is essentially writing blank checks to people who have no credit history, who have no income, who have no assets, who have no
No financial
responsibility.
understanding of the long-term obligations. And to pick up on that, and this is apolitical, right? We're trying to rise above the fray here, but at the end of the day, when you make college tuition affordable or essentially available to everyone, it increases demand for limited supply, which drives up inflation, right? There's more people competing for seats in the classroom, and then absolutely it increases the price. So to your point, just agnostically, that's what happened.
And this goes back to 1998, I think, is the first year on here. We've had plenty of Republican and Democratic administrations in the interim, right? So it is certainly not a political thing. It's a government thing in general.
There was a great
So
article in the Wall Street Journal this week about this very topic, and they had a statistic about how why won't it change? There's plenty of folks right now. The pulling back. They were saying that many fewer Americans today believe that college is the best choice for them, and it's down 20 points. Maybe 56% of people thought so about 10 years ago. Maybe it's a third or so think so now, and they
yeah,
were wondering why won't it change? And they had this statistic which really blew my mind. According to the article in the Wall Street Journal, 1 in 40 people who are employed in the United States are employed at a university or college, which just blew my mind. So they've got a huge, powerful lobbying arm, which, of course, affects the outcome. So just an intriguing data point there for
really
you to build. Hard to believe, right? 1 in 40. Now, I don't
more
know if
than
that includes like university hospitals, right? But yeah,
yeah,
incredible,
okay,
incredible.
okay, yeah, that's a lot. That's more than 2% of the entire workforce.
Yeah,
Um,
wild.
yeah, and I wonder what the breakdown is of administration, right? Like how many of those people are administrators versus like actual educators, or if it's if there's healthcare lumped into there as well. Um, so that's pretty interesting.
Yeah,
And
sure was.
yeah, last thing I want to take a look at is more of just a practical, practice management. We're thinking about where to allocate, and for the last year, 18 months or so, cash has been fairly attractive. Earning 5+% in money markets or CDs and essentially low or no risk vehicles has been an attractive place to be. This is also partially the reason why we had in our kind of 2024 forecast that there's quite a bit of cash that could find its way into equities as rates come down. And I think the important thing to note is that looking at these last two times when rates were fairly high and they did start to fall, is how quickly did those yields fall down. And so in that first situation, from 2001 to 2002, you had March of 2001 money market rates paying 5.8%. Just a year later, in March of '02, they're paying half that, less than half that,
Oh, wild.
2.6%.
That's incredible.
And then the same situation in 2007, from October '07 to October '08, you had really a more than 50, almost a 50% decline in the cash yield that you were getting there. So I do think that cash is somewhat dangerous. Now, if you're sitting on it for to fund short-term liquidity needs, or it's expected to be withdrawn throughout that period, not necessarily a big deal because you're not really having any sort of reinvestment risk or the need to put it anywhere. But if you're kind of just waiting for that shoe to drop that we talked about, I'll buy in when the time is right and I'm going to earn my 5% in the meantime. That 5% can evaporate pretty quickly and can get, at least as of today, it's above the rate of inflation, right? So you're actually earning a real yield on it. But that could change, quite quickly, where you're all of a sudden now you're earning a yield on your cash that's less than the rate of inflation. And then what do you do with it? So I just think that this is something important to note, that these money market funds hold very short duration, short maturity investment vehicles, and those yields change quickly as rate environments change. And if the Federal Reserve does, in fact, cut rates here potentially in March, it could be a rate cut. I think there's like I think the latest percentages are like 50-50 for a March rate cut. Um, you could start to see those cash yields come down
And
pretty quickly.
we've been talking about this for months. And interestingly, of all the points that we make on this podcast, the one that many clients has asked me about was when we said months ago that it might be appropriate to add duration to portfolios. And I don't think we colored in enough around that. But to build on that, what Zach is saying is that as interest rates go down, this might be a decent time to look for longer term investments that can help you lock in rates for a longer period of time. So that's something
Yeah,
we're certainly working on with clients at the moment, but might be prudent to start considering that as well.
for sure.
Cool. Anything else, my friend?
That's all I got today, man.
Well, I'm excited to see you folks on our next podcast where Zach and I will be talking more. I planted the seed on my first slide about how difficult it is to make predictions. I want to expose um, some of the prognosticators out there. How good is Jim Cramer? How good are the screens you see that come through your Yahoo newsfeed? We're going to expose some of the difficulties in picking winners and losers, and help us build out some rules for investing if we're trying to get better returns than the average person. So that's next
Love
time.
it.
Please join us on Finance Footnotes. And as always, if you have questions, please let us know.
Love it.